Hello, and
Hello.
welcome to another week of
GoodGood Investing.
GoodGood Investing. So excited to be here. It's cooling off in Texas. It feels amazing.
I feel like I can be outside for a longer time.
Yes.
In the summer, I didn't want to go outside at all.
It's gross. And did you know the state bird in Texas is a mosquito?
And we have like this, is it crickets or grasshoppers like that are on buildings?
I don't know, but one of them is dead in my guest room. And I'm like, how the heck? My dog can't even get through the dog door. How the heck did a cricket end up upstairs in my guest room and just decided to die there?
Oh my gosh, yeah. That is hilarious.
Did I tell you about the time a rat died in my baby's crib?
No. Oh my god.
Maybe that's for a different podcast, but it was traumatic. I cried. I had a breakdown that day. Literally,
I want to die. How did it get there and how did it die? So, and she didn't have any bites, right?
No, okay. So she wasn't born yet. It was right before she was born. So we had a nursery set up. And guys, I'll keep it short because you're here to learn about taxes, not dead rats. But yeah, so we put out poison for the rat because we had huge rat infestation. It was horrific at our last house. We put out poison. The rat ate the poison and then went to a soft place to die, which was my baby's crib.
Oh man, I'm so sorry.
We threw out the sheets. It was, and then his rat brother, somebody, brought back the poison, and because he'd only nibbled it and like took it off and hid it somewhere, brought it back and stuck it in the middle of our living room, and my dog ate it.
Was he okay?
No, I had to go get my dog's stomach pumped.
Oh my gosh.
It was horrific. And I mean, my dog my dog died, but not because of that, just because of something else later.
Oh my goodness.
It was
traumatic.
Anyway, guys.
Sayonara, old house.
All right, we're gonna
to newer
not
and
claim
better.
any of that negative energy. We're gonna move right into our exciting guest for today. Oh wait, quickly, should we talk about what GoodGood Investing is and why we have this podcast?
GoodGood Investing is for you, the busy professional and the successful entrepreneur, to learn about different passive investing vehicles. And specifically, we concentrate on multifamily investing. So anything multifamily, we're your girls, we're your ladies, we got you, we know the answers. So find us on goodgoodinvesting.com. Sign up for our investor club for emails and for more knowledge in our podcast, and then sign up to have a call with us.
Yeah, easy as 1, 2, 3, totally passive. Guys, today we have Deborah Pritchard on, and she is a CPA and also a passive multifamily investor. She's been investing in multifamily since 2008. Yeah. And kind of a crazy story how she got involved in the middle of a recession.
Right.
Which is, what the word is going around right now, too. Yeah. So if she thought it was a good time, then maybe it still is, even though we're heading into an economic downturn. Isn't that right?
Yes, and I loved how she broke it down and compared multifamily to 401k and
stock market
and the stock market, and how you can offset taxes with both vehicles, but multifamily wins. And so I knew that it would, and I was so happy that you talked about it.
Yeah, guys. So get ready to learn all about Deborah, and also she has some pretty cool things to say about foreign investors as well. So enjoy. All right. Hi, Deborah Pritchard. Thank you so much for joining us on GoodGood Investing.
Well, thank you, Rachel, and thank you, Andrea, for having me here. I'm happy to be here.
Oh, fantastic. So let's get started. Tell us a little bit about your backstory, where you live, where you're from, kind of what led you here.
Okay. I grew up in Canada, about 90 miles north of the Montana border. Lived in England, lived in the Netherlands, moved back to Canada for a bit, moved to the U.S. in 1994. Became a U.S. citizen in 2008. So prior to that, we were just here on visas. I started investing in multifamily in 2008.
When you first heard about multifamily, what drew you to it?
Well, I actually went to a Lifestyles Unlimited, in-person Dale Walmsley event. And honestly, he's a very charismatic speaker, and he pulled me in. I was ready to just jump in right there and then. Called my
So
husband up.
2000.
He,
Go ahead. Sorry.
I was going to say, so I'm much more the class A. He's the type B. So he was a little more hesitant, but he said, I trust your judgment, and
Nice.
we've never looked back.
Now, who decides to get into real estate in 2008? Because if I remember, that was not a fantastic time for the real estate market.
No, I mean, we couldn't get leverage, so you had to put partnerships together and buy for cash, stabilize the asset, and then you could go back and you could put debt on it at that time. We get all our money back and go on to the next one. So.
Yes, and we were talking about on a previous episode that multifamily performs so well during recessionary periods because when people can't afford the cost of maybe their nicer homes or nicer apartment buildings, they move into B and C class multifamily. Now, you said that you are from Canada, which is so cool because Andrea's husband is also from Canada.
Yes, he is. And all Canadian people are so super nice.
Well, there you go.
I'm a big fan.
But that helps me a lot with all of the foreign, because it doesn't really matter what country you're from. We file all the same foreign forms until you become a U.S. citizen. So it doesn't matter if you're from Israel, if you're from Colombia, if you're, we look to tax treaties to see if we can reduce tax rates, but all the foreign reporting is similar. So
that's super exciting. So that opens doors for our Canadian family and friends to come and invest with us in multifamily.
Absolutely. I was just on a conference call with 2 Canadian chartered accountants, a Canadian syndicator and a U.S. syndicator, and they're going to pull, the U.S. syndicator is pulling in that Canadian syndicator.
Wow, and so it doesn't matter what country, right?
No, it's just that there's, some countries. So if you got Canadian investors, you want the deal set up, structured a certain way. You want it to be a limited partnership as opposed to an LLC. But those are, just so that the Canadians receive pass through. They down here, they'll probably file as a corporation. So none of those Canadian investors actually have to file a tax return in the U.S. So it's, and so, we were just all strategizing on how, what was the best way, what are the deadlines in Canada versus the deadlines here in the U.S. for filing taxes.
Oh, that's great news. I'm going to have to go back and tell all my family and friends in Canada.
Yeah,
and Ecuador, actually.
I don't know that. Yeah, and Ecuador, that's right.
Yeah.
I don't know that there's many people that know that you can invest in real estate as a foreign person and not have to deal with any of the management, which of course would be difficult, especially if you're overseas, right?
Yeah.
And not knowing anything about, the laws and the U.S. and stuff like that.
Right.
So Deborah, tell us a little bit. So you said that you started out in multifamily in 2008.
Yeah.
And I'm guessing, did you start off passively?
Yes, and I'm actually still a passive investor. I can't be a real estate professional because I work too many hours doing taxes. But I've been a passive. My husband and I are in 17 deals right now.
Wow.
And so, I still get the same benefits as somebody who's a real estate professional. It's just a timing difference for me. And so, last year I had 5 deals that sold. So I was looking for new deals because, the current deals I had were not going to have enough depreciation to offset all my gains. So I was looking for new deals to deploy all that capital to give me bonus depreciation to offset my gains.
So let's dive in a little bit more into that, because that is such a huge aspect of multifamily syndication is the bonus depreciation that people get to take advantage of. And we're very careful on the podcast, not trying to talk about taxes, but since you are a CPA and you also have an awesome perspective being a passive investor, can you talk a little bit more about why maybe, compared to maybe single family or other types of investments, why multifamily is more advantageous from a tax perspective?
Yeah, I mean, the thing about when you talk, it's hard to talk about taxes because everybody's tax situation is different. But so long as if you are a passive investor, all passive income is offset by all passive losses. So, I can have deals that are passive sell, and I can get new deals that are passive, brand new, that offset, that are giving me losses that will offset income. But there's all sorts of rules around that as well. So I might have, if I make less than 150,000, if I make less than 100,000, I might be able to let 25,000 on my losses go through on an annual basis. So there's so much that goes into determining. That's why you need to have somebody that understands real estate, because there's all kinds of, the real estate laws are really there for us to take advantage of in the tax code. Now, the reason we went to multifamily is it's, because multifamily, we get this thing called the cost segregation study. So we'll buy an apartment building and we'll have an engineering firm go in, and that firm will say, okay, it classifies everything that you've just purchased into 5-year, 15-year land and 27.5 years. And the tax code currently allows us to depreciate 100% anything less than 20 years or less. So all of that 5 and 15-year stuff we can write off. You don't often do a cost seg when you're buying a single family home. They can be done depending on the purchase price. But if you don't do a cost seg, you're buying a building and land. And so you're not going to get nearly the depreciation deduction that you're going to get in a multifamily. So that's why, we chose multifamily because it's harder to find somebody to run all my single family rentals than it is. So if you're going to be a passive investor, but then it's, you really need to get to know who your lead GP is. You have to build that. To me is more important than anything, is getting to know who the lead GP is. Then I look at the deal. But first I need to know who you are.
Yes.
Yeah. So for all of our W-2 friends, when they're comparing maybe investing in stocks and selling stocks versus getting into multifamily and then selling the multifamily, with us at our sale event, what are the tax implications? Is there a way to compare both?
No, I mean, for W-2 people, they're not going to be real estate professionals. So they're going to be a passive investor like I am. But the thing about, when I get it, if I have gains in a stock, I've got to sell it and then I have to recognize those gains. When my apartment building is appreciating, I'm getting distributions because I'm getting, there's cash flow coming through. So cash flow allows me to get a distribution, which is not taxable. If I'm getting in a stock, if I'm getting dividends or interest, it's taxable back in the year I receive it. Distributions are not taxable. Then when the apartment building sells, I've had several apartment buildings that did a refinancing and I got all my money back. So I could turn around and invest it into another deal. That was not a taxable event because I was allocated qualified non-recourse debt. And in real estate, that gives me basis to take those distributions. So it doesn't make it a taxable event. I couldn't do that in the stock market.
So, in summary, it sounds like we're paying a lot less taxes on the benefits of multifamily and the returns of multifamily versus what you would get in the stock market.
You should be. Everybody's situation is different, right? But but generally, we have not paid. My husband and I still have a stock portfolio as well, and it's just like crashed. We just wish we'd have put it all in real estate right now, but so there hasn't been a lot of. And the thing is even though it's crashed, we still pay tax on dividends. Anybody and any of those stocks that are still paying dividends are still going to be paying tax on it. So it's all my hard-earned money from my, 401k and stuff that have gone in there and it's down 20% this year, and maybe it's, because and in a 401k, you're limited to whatever the firm, what they choose for you to be able to invest in. In the real estate, I pick my general partners and I pick the deals that I want to invest in. I pick the states I want to invest in. So I have a lot more choice than I do in my 401k.
Right.
And it's interesting, a few minutes ago you said that these are real estate incentives in the tax code, not loopholes. So everything that, we're doing to take advantage of the tax code of real estate is entirely legal.
Yeah, the tax code says that we should do a cost segregation study.
Right. Yeah, that's just an important note. I just wanted to hammer
Yeah.
home. So we've talked a little bit about W-2 and passive income and passive losses. So what would qualify I know the answer to this, but I'd love to hear your take. What would qualify someone to be a real estate professional? Say maybe a husband works a busy W-2, but his wife is stay at home, and maybe they're interested in getting to see if she could qualify for real estate professional status. What would that look like?
So if you don't have a W-2, then so there's two tests to become a real estate professional, and the first test is you have to be in the business, property trades or business, and you have to have 750 hours minimum. If that is no W-2, and then the second test, there's 7 of them, that we get a choice from, but basically most people qualify by they have to materially participate for 500 hours. So they have to be involved in the day-to-day, or maybe they're the underwriter on your team, maybe they're the asset manager on your team, maybe they're investor relations on your team, but that they all have a job. That person has a job in the day-to-day running of that asset. If you've got a W-2, unless it's part-time and you have a contract that says, I was just reviewing a contract, he's only has to work 780 hours a year. Well, it's easy for him to work more than that in a real estate job. So he will be a real estate professional, even though he's getting a W-2.
And what about real estate agents? So they're licensed agents. They are selling maybe single family homes day in and day out. Do they qualify as real estate professionals to get the tax benefits?
Usually, yeah, I'm going to say it depends, but I mean, it's a lot easier for them to qualify. Yes, yeah, because they're in real estate, the real estate business.
So they don't have to be part of the general partnership team in their multifamily investment. They could be working their real estate job and just passively investing in multifamily.
No, they still, because they wouldn't meet the material participation. They'd meet the 700, the first test, they'd meet the 750 hours. But if they are not materially participating at some level in the asset ownership, they wouldn't meet that 500 materially participating test.
Okay.
Gotcha.
And what does the real estate professional status award somebody on top of maybe just the standard passive income?
It basically changes your passive losses to ordinary. There's no, so they're no longer, nothing is passive anymore. It's ordinary and deductible in the year they are actually incurred. So
fantastic. And would that also apply for maybe their spouse's W-2 income?
Right. I was going to say, so if you got a loss coming through and any other type of income, it could be portfolio income, which is, stocks, dividends, interest and stuff, or it could be W-2 income, retirement income. It is all offset by a real estate professional's ordinary losses.
Okay, fantastic. Yeah, that's super great to know. So tell us a little bit, do you have any regrets so far in your investing journey?
I mean, we haven't lost any money in my investing journey, but certainly the returns have not always been there. And I learned, in the beginning, I really got to know my GPs. I used to go on all of these site visits because I really wanted to get to know them. And I thought, well, I'm going to diversify my GPs just like I do my stock portfolio. I wouldn't advise that anymore. Now I would advise, if you find someone you trust and you know how they underwrite, I would stick with them. But you have to have more than one, because they don't always have deals available when you have cash. So you need more than one person that you trust. But in those beginning days, I mean, I did, he had more of a project management background as opposed to a financial background. So now I also look for people that can read a set of financials. I can contract out, get several bids to do, work. But if you can't read the financials, we're all in big trouble. And so he could not read a set of financials. And, it was a happy day when we got out of all those deals. The other thing is we actually removed him as a GP. Like, we had the percentage of approval to remove him, and he turned around and he sued the LLC. This was in Texas. He sued the LLC and he sued every member in that LLC.
Wow.
So I mean, we were in there in our personal name. So he lost. I mean, the LLC protected us, but it was still a 2-year ordeal. So.
Wow, what a nightmare. Did you, so I'm imagining the returns were.
Well, we actually used, basically they used all of his capital to pay the attorneys while the court case was going on. So distributions and all that kind of stuff, they just used that. And as I said, because he lost and the court didn't, he wasn't entitled to anything. He really lost the entire case. So.
Wow. So even as a passive investor, even though you're not involved in the day-to-day operations, you still want to make sure that you have a baseline level of education so that you can, make sure that a deal and the sponsors are the right fit.
You know what? If you're getting into these deals, what I find from doing all these tax returns is most people don't read the deal. They don't understand how it's going to work. They haven't read, like a PPM could be, 114 pages or something. They need to they need to start reading that, or they need to really understand. Ask their GPs. How is this going to work? This year, the past couple of years, we've had a lot of sales, and honestly, calculating basis, people don't understand. They'll think all the numbers on the K1s are incorrect, but the numbers on the K1s are correct. And we can, I've gone through several basis calculations with several investors this past year to show them how the numbers on there arrive at the gain and the distributions that they received. So,
and the K1s, we know what the K1s are, but if you could just explain what that is.
Yeah, in a partnership, we're all individual investors or entities, and the way that the income from the apartment building is reported to us is on a form called a K1. And so it's would be like W-2 is reporting your wages, a K1 is reporting our income or loss from a partnership which owns an apartment building. So,
perfect.
What's the one mistake that people make that you wish they knew, or something that you could educate on to help people, like this one big glaring thing that everyone gets wrong? Is there something?
There's not one big glaring thing. What I do think is that people who are passive investors, sometimes are being told and believe that they can take advantage of those passive losses in that first year. Well, it's really going to depend on your individual situation. You may or may not. You won't lose them. They'll be carried forward. It might just be a timing difference. And so they really need to understand. They should talk to their CPA saying, I'm thinking about getting in this. If I get a bunch of depreciation, big loss in box 2 of my K1, will I be able to use it? And so they're really disappointed when they go to their CPA, because I've actually had several CPAs this year, because she said, they don't believe me when I tell them that they can't use it. It's being suspended because they were told they could use it. And maybe they just misunderstood. So we always say, talk to your CPA. They, and if they don't know about real estate, then maybe it's time to switch CPAs if you're really thinking about getting into the real estate investing world.
Which brings me to my next point. How can our listeners get in contact
I believe,
with you?
My work email address is dpritchard@mrmcpas.com. So.
Okay, great. And I will link that in the show notes.
Yeah, because that would be the email is definitely the easiest. Telephone takes too long because we all like to chat and ask how your kids are doing, or what's the weather like. So it's much faster for me to respond to an email.
And you're located in Dallas, I know.
We're in Frisco, Texas. Yeah.
Okay. Yeah.
And then do you help if we have investors in other states, Can you help?
Yeah, I mean, we do tax
well?
returns in all 50 states. I mean, even my own personal. I
Okay.
mean, in the 17 deals, there might be 3 or 4 now that are in Texas, but the rest are all in other states. So, yeah.
Okay, perfect.
Yeah, and we have all sorts of foreign investors in all, in multiple syndications. We have clients who actually live in other countries, so, we're always looking to the treaties
That's
to see if
incredible.
there's a preferred tax rate, when we're dealing with any of these foreigners. So,
Yeah, that is fantastic. Well, Deborah, thank you so much for your time. You've brought us a wealth of knowledge, and I know our listeners probably are much more educated after this episode as well. Guys, definitely get in touch with Deborah if you are interested in learning more about how syndication might impact you and your taxes. Thank you again,
Thank you
Deborah.
yes,
so
thank
much.
you, Andrea and Rachel. Good to see you both. Bye-bye.
All right, Andrea, that was pretty awesome. I learned some things.
I did too.
I really did.
I did. Yep. I loved how she broke everything down, and I just feel like things are so much more clearer now.
Yeah, definitely.
But again, talk to your CPA.
Yeah.
Contact Deborah, or if you have a real estate specific CPA, always seek out information so that you're aware of what your investments are doing and how you can get the tax benefits from it. So make sure you're always seeking that CPA
and I did
advice.
could not agree more. And I also did love how she said, before you invest, contact a CPA and be like, hey, I'm looking at investing in this deal. They're projecting, X percentage of bonus depreciation. Is that something I'd be able to claim next year or this year or what have you? How does it implicate your taxes if the property, say, in Georgia and you live in New York? Stuff like that is really important to know. And, we're not tax professionals and we'll never pretend to be.
Right.
We just simply provide you the opportunity to invest. But it is up to you to also do your due diligence, even as a passive investor, just to make sure that, you trust the sponsorship team, like Deb said. Also an amazing point.
Yes.
You want to make sure they have a track record, right, of success.
Right.
And I went to a conference this past weekend, and one of the speakers said, if you're talking to a deal sponsor and they're like, oh no, it was all fine, everything outperformed projections, we did great. He's like, they're either lying or they haven't been doing it long enough. And both are bad options.
Yeah.
So make sure you're working with someone that you trust, has a track record, and knows what they're doing, has seen it all, done it all, etc. I can assure you that Andrea and my team have, and we definitely welcome everyone to contact us to learn more about that as well.
Yes, absolutely.
Well, until next time, Andrea, don't invest good.
Invest twice as good.
Bye.